This is the second lecture of the what I'm trying to do in four parts of the build up and the takedown of the economy. Last time what I did was discuss foreign capital, which is going to be very much a topic today, and how foreign capital provided the resources for our banking system to funnel the money to the market segment most desired, using that capital, which were the U.S. consumer, and most of the money went into U.S. home building, and it created a asset bubble. It spread out in general, and the banks were heavily invested in this until the plug came out, so to speak. And really what stopped the whole process of the buildup is the fact that the amount of funds loaned were so excessive that they really ran out of qualified borrowers who could service the debt and pay it off. And it was the summer of 07, August 3rd of 07, when it became clear to the markets that they did excessive financing and put into the hands of so many marginal borrowers the funds that were awash from abroad. Then we went through this process of meltdown of the market value of the assets of the commercial banks. And the commercial banks, then particularly with market value accounting, had to confess to the fact that the left-hand side of the balance sheet has shrunk to less than the right-hand side of the balance sheet. And then we went through this ugly process of shrinking the right-hand side. And that was in about a three-part step. It was the first part was whoever loaned the funds to the banks wanted their money back and withdrew the funding, which forced more selling, which forced financial prices down quite a bit. And then at the end of each quarter, every commercial bank has a regulatory reckoning, in the sense that they have to meet regulatory requirements of minimum minimum capital. And the minimum capital ratio is a ratio of assets to capital. And as assets get written off, capital gets written off, and then they end up with too many assets relative to their capital. And they try to replace the capital to the best extent they can, but by, let's say, the third quarter of the financial meltdown, it became clear that there were a lot more losses ahead, so they were no longer able to raise the outside capital. And thereafter, the only way they could get back into regulatory compliance was to shrink the assets relative to the capital, which meant selling quite a bit more assets and pushing the prices down further. And that kind of culminated in November and December of 08. And the prices were remarkably reduced in the market. And the banks at that point ran out of private sources for capital. And then they sought the shelter of TARP money, which to replace the no longer having private sources of capital, so we went to government capital. And then on top of that, we started a series of cover-ups of the fact that the left-hand side had shrunk quite a bit more than the right-hand side. And the cover-ups were first by the accounting board, the FASB. They were heavily pushed and influenced by Congress. Effectively, Congress said, if you don't stop this mark-to-market accounting nonsense, we're going to take over the regulation of accounting, which they didn't care to lose the control of their accounting standards. They moved very quickly. In fact, probably within weeks, I would say, as opposed to when they put those, when they change FASB rules, it probably takes years if they're doing it at their own speed. This was in matters of days or weeks. So the accounting board got into the cover-up business to really indicate that the banks didn't want to show it. We don't want to know about it. Please don't show it. On top of that, the government gets heavily involved in the cover-up because we have this over-the-top episode of the Treasury Department conducting a stress test. Now, if you think about this, this is quite remarkable because the Treasury Department does not examine banks. That's not part of their mission. Bank examiners are the Office of the Comptroller of the Currency and the FDIC. And the Federal Reserve has some control over bank holding companies as well. But the Treasury, Secretary of the Treasury, has no control. And to have this extraordinary intervention by the Treasury Department to examine banks to find out who met the stress test was beyond law. And maybe it only occurred because it probably might have only been enforced on banks that took the TARP money as a condition of taking the TARP money. So the Treasury Secretary of Treasury gets into the bank examination business, and the purpose of it really is to conduct a cover-up. It was clear to me that the last thing a bank examiner ever wishes to do is to examine a bank and find out it has insufficient capital. If the word gets out that the bank has insufficient capital, there's immediately a run on the bank. And it immediately puts the bank out of business. They have to liquidate the bank immediately. So, as a matter of fact, in the ordinary course of events, after the FDIC does a bank examination, it conducts and maintains a list of troubled banks. However, the list of troubled banks are not revealed to the public, and those who try to use freedom of information to get to it cannot get to it because it is considered, quote, privileged. And so for them to be taking this extraordinary bank examination and then gleefully go to the market and say all our banks are clean and they've passed the stress test was a complete over-the-top signing up the Treasury Department for the cover-up. They were a participant in the cover-up. And the reason is the market value of the derivatives held in those portfolios are really even for the investment quality derivatives or securitizations are some small percentage of the initial price. So the only way we can get by without totally liquidating the entire banking system is to pretend, and that's where we are. And it's been effective, very effective. I mean, I doubt very much that even bankers understand that, and many people in this, certainly newspapers don't understand that, and certainly the Wall Street does not understand that these banks were blessed to pass the stress test. It's completely a fiction. But the alternative would have been so costly we couldn't bear it. You and I wouldn't want to be paying it. No government could stand to pay for the shortfall of liquidation of large banks. The size of the portfolios are so large. Just let me tell you how large it is. You take the 4 largest banks in the United States. What percentage of total deposits would you believe are held by the 4 largest banks?
89.
Well, about 50 in the 1990 crisis, Citibank at 3 or 4% was the largest. And maybe the top 5 were certainly no more than about 8% of the total deposits. At this point, the concentration of deposits are such that I believe the top 4 are 55% of the deposits. So we have a level of concentration of deposits in the remaining, investment banks and standing commercial banks that if they were liquidated, and it would be such a massive liquidation, and there'd be no solvent buyers out there to buy it. So basically, they would be getting pennies on the dollar for the assets sold, and then you and I, as taxpayers, would have to pay the deposit insurance shortfall, which would be enormous. We would have a bill of something like $10 trillion coming down to us as taxpayers. So the more prudent thing to do is to lie and cover it up, and they've done it very well and cleverly. I have to say that. Whatever you want to say about Tim Geithner, I mean, they've been very, very clever about it. So that's kind of where it stands. Now, what I'd like to continue, I just want to spend 5 minutes on this because some people are coming into lecture 2 and miss 1, etc. So I just wanted to give you some idea of the background.